$100,000. It's a significant amount, and you want it to grow, but what's the best way to make that happen? Should you go with QQQ for explosive growth, or does JEPQ with its higher dividends offer a better path to success? The decision between these two ETFs could dramatically affect your returns. Both QQQ and JEPQ track the Nasdaq-100 Index, but they go about it in very different ways. One focuses purely on growth, with tech stocks leading the charge, while the other adds income through a unique covered call strategy. In this video, I'll show you and John a deep analysis of both ETFs to help you understand which aligns better with your financial goals. I'll break down their performance, compare their strategies, and help you and John decide which ETF might be the better choice for your $100,000 investment. Both offer solid returns, but one has the potential to cross a $10 million valuation, while the other pays over $25,000 in monthly dividend income. An ETF, or exchange-traded fund, is a type of investment that allows you to buy a collection of stocks or other assets all at once. Rather than picking individual stocks, you're investing in a basket of different companies, which helps spread out the risk. For example, with an ETF like QQQ, you're investing in a broad range of tech companies all bundled together. ETFs are traded on stock exchanges just like regular stocks, so you can buy and sell them throughout the day at market prices. One of the big advantages is diversification. Your money is spread across a variety of companies or sectors. When deciding between JEPQ and QQQ, it's essential to understand how each ETF operates, the type of returns they offer, and how they align with your investment goals. Both ETFs track the Nasdaq-100 Index, but they take different approaches in terms of strategy, risk, and performance. QQQ, launched in 1999, is a growth-oriented ETF. Its primary focus is to track the Nasdaq-100 Index, which includes 100 of the largest non-financial companies listed on the Nasdaq Stock Exchange. It has a heavy concentration in the technology sector, 51.33%, meaning QQQ provides exposure to some of the biggest names in tech, such as Apple at 9.7%, Nvidia at 7.41%, Microsoft at 7.85%, and Amazon at 5.62%. These large-cap stocks are ideal for investors seeking capital appreciation. The ETF also includes holdings in communication services at 15.98%, consumer cyclical at 13.15%, and consumer defensive at 5.98%. But QQQ is known best for its tech exposure. In comparison, JEPQ, which was launched in 2022, combines both growth and income by using a covered call strategy. Like QQQ, JEPQ invests in the same companies that make up the Nasdaq-100 Index, with a heavy focus on technology stocks at 50.21%. Some of the top holdings again include Apple at 7.99%, Nvidia at 6.29%, Microsoft at 6.55%, and Amazon at 4.87%, all similar to QQQ. However, what sets JEPQ apart is its strategy of selling covered calls on the stocks it holds. So what does that mean? Basically, JEPQ sells the option to buy the stocks it owns at a certain price. In exchange, JEPQ receives a payment, called a premium, which it then passes along to its investors as dividends. In simple terms, the covered call strategy is like renting out your stocks for a price and getting paid for that rent. It's a way to generate extra cash from the same stocks you already own. This adds extra income to the fund, which is why JEPQ offers a much higher dividend yield of 9.92% compared to QQQ's small 0.56%. While QQQ is focused primarily on growth, JEPQ balances growth with income. The trade-off with JEPQ is that its growth potential is somewhat capped due to the covered call strategy, which limits the upside during strong market rallies. QQQ, on the other hand, benefits during periods of strong growth in the tech sector, and its performance isn't restricted by options trading. This makes QQQ the better choice for investors who are looking for maximum growth, especially during tech booms. In terms of performance, QQQ has outpaced JEPQ in the short term. QQQ's one-year return of 16.75% has significantly outpaced JEPQ's 4.77% return. Over a longer period, QQQ has proven itself to be a growth powerhouse, benefiting from the strong performance of tech stocks. JEPQ, while newer, offers a steady and consistent performance due to its income-generating approach. The covered call strategy helps reduce volatility and provides more stability during market downturns. However, this stability comes at the cost of limited growth during strong bull markets. In other words, while QQQ can reach high in tech booms, JEPQ offers a more steady ride, appealing to income-focused investors. Now remember, in the end, I'll show you the potential returns from a $100,000 investment over 10, 20, and 30 years from both ETFs. Both perform well, but one could reach $10 million, and the other will pay over $25,000 in monthly dividend income. The risk profile of these two ETFs is also different. QQQ is generally more volatile given its heavy exposure to the tech sector, which tends to experience sharper swings in price, especially during periods of market uncertainty or when tech stocks are underperforming. JEPQ, however, is less volatile because the income from its covered calls can help buffer against market dips. This makes JEPQ a better option for investors looking for stability and a steady income stream, while QQQ is more suited for those who are willing to take on more risk for the potential of higher returns. When it comes to dividends, JEPQ stands out with its high dividend yield of 9.92%. Providing a reliable income stream for investors. This is especially attractive for those who need regular income from their investments, such as retirees or income-focused investors. In comparison, QQQ offers a much lower dividend yield of 0.56%, reflecting its growth-centric focus. QQQ distributes dividends, but they're low compared to the income generated by JEPQ. In terms of liquidity, QQQ is one of the most liquid ETFs on the market, with an average daily trading volume of 31 million shares. This high liquidity makes it easy to buy and sell without significant price fluctuations. JEPQ, while also liquid, doesn't have the same trading volume as QQQ. Additionally, QQQ has a lower expense ratio of 0.2% compared to JEPQ's 0.35%. Now that you've got a solid understanding of the strategies and performance of both JEPQ and QQQ, let's look into what a $100,000 investment in each ETF could potentially grow into. This comparison will give you a clearer picture of how these two ETFs could impact your financial future, taking into account both capital appreciation and dividend income. Starting with JEPQ. It has a current dividend yield of 9.92%, but due to recency bias, let's assume it maintains a 5% yield for the coming years with a dividend growth of 6%. Additionally, since its inception, it has had an average share price appreciation of 2%. Based on these metrics, if you invested $100,000 in JEPQ, here's how it breaks down. In the first year, your investment would grow to $107,000. Over a 10-year period, this investment could increase to $215,911. Looking further ahead, after 20 years, your $100,000 investment in JEPQ would grow to approximately $606,549. By the 30-year mark, the value could reach an impressive $2,484,713. After 30 years, you would be receiving around $329,481 in annual dividend income, which translates to about $27,457 in monthly dividend income. JEPQ's total value added would be $2,384,713, with capital appreciation contributing $337,034 and the dividends reinvested adding a substantial $2,047,679 to the total. The big question is, of course, can QQQ beat that? Well, let's find out. For QQQ, the current dividend yield is 0.56%, with a dividend growth rate of 10.18% over the past decade. The ETF has an annual share price appreciation of 16.66%. So, if you invested $100,000 in QQQ today, after 1 year, your investment would grow to $117,220. Over the course of 10 years, with consistent growth, your $100,000 would increase to $484,059. And in 20 years, it would grow to $2,302,233. If you held the investment for 30 years, assuming the same growth rate continues, your initial $100,000 could reach $10,851,269. As for the dividends, by the end of 30 years, you'd be receiving $7,459 annually in dividends, or about $622 per month. The total value added to your investment would amount to an impressive $10,751,269, with the majority of it coming from capital appreciation, $10,669,313. The dividends reinvested over time would add $81,957 to your total. When comparing these projections, it's clear that QQQ offers superior long-term growth, mainly in terms of capital appreciation. After 30 years, QQQ's total value added to your portfolio would be more than 4 times that of JEPQ, with a total value of $10,851,269 compared to JEPQ's $2,484,713. But if your priority is to maximize income, JEPQ's higher dividend yield might be more attractive, as it pays around $27,000 in monthly dividend income compared to only $600 from QQQ. Want to know which is better between QQQ and QQQM? Click the video on the screen to find out.